Good morning and thank you for joining this webinar about residential property income for individuals, expenses and deductions. My name is Kathy and I'll be co-presenting the webinar today with Graham. The webinar will last for around an hour. The information you will be receiving today is correct at the time of delivery, which is the 25th of October 2023. Guidance is updated regularly, so we advise you to refer to gov.uk for regular updates. I'll start by explaining how to use the control panel and ask questions. If you're watching on a PC, laptop or Mac, you'll have a control panel like the one on the screen now. Near the top of the control panel in the audio box, you'll see the red muted message. Everyone's microphone is muted so that you can hear the presenters clearly. You can adjust the sound from this audio box. There's a message at the top right-hand side of the screen for anyone who can't hear me. You can usually fix audio problems if you select the phone call button and then make sure you go back and select the computer audio button again. If this doesn't solve the problem, close the webinar and log back in. Halfway down the control panel, there's a handouts box. The handouts will include links to the information being covered in the webinar today. You can download these during the webinar. They're in two formats, Word and PDF, so please download in whichever format you prefer. There's a question and answer box near the bottom of the panel. Type your question in the box and then send. You can make the question box bigger by selecting the symbol at the top right of the question box, and you can then resize the box. Before you leave the webinar, you can choose to save the question and answer log. PC or laptop users on the control panel, select File, that's the top left-hand corner of the control panel, and then Save Questions log. Mac users on the GoToMeeting toolbar, select File and Save Message log. I'll show you this again at the end of the webinar. But please note, a link to a recording of the webinar plus useful links will be sent via email to you within a couple of days. If you're joining us on a phone or tablet, you may see a toolbar instead of the control panel. In that case, tap on the question mark to ask a question. You should take a screenshot to save answers, and we suggest you do this as you go along, as you will not be able to save the question and answer log on a mobile device. Tap on the document icon to download the handouts. The icon should already have appeared as the handouts are available for you to download. If you're unable to download the handouts, the links will be included in the follow-up email you will receive in a few days. We have colleagues in the background answering your questions during the webinar using the control panel question and answer box. They will aim to answer as many of your questions as they can today, but may not be able to reply to them all. Please note that we are unable to answer questions specific to individual circumstances. So for that reason, can we ask that you don't post any personal information in the question box? Finally, if we have any groups of attendees today, could I ask you to use the question box to tell us how many additional people are taking part? For example, if there are 3 of you taking part as a group, then please type 2 in the question box. Just give a few seconds for you to do that if you need to. Okay, thank you. Right, now we're going to move on with the presentation, and for that I'm going to hand you over to Graham. So good morning, Graham.
Yeah, good morning to you as well, Kathy, and good morning and a warm welcome from myself to everyone who has joined us here today. So in today's webinar, we'll cover expenses and deductions for residential property, including revenue and capital expenses, repairs and improvement costs, expenses before you start letting your property, mortgage and finance costs, travel costs for business journeys, and replacement of domestic items relief. Today's webinar doesn't cover the basics of letting property. Our webinar, Residential Property Income for Individuals and Introduction, covers what we mean by income from property, furnished holiday lettings, when to record income and expenses, the property income allowance, and the rent a room scheme. So we'll start with the basics for expenses and deductions. To work out your taxable rental profit or loss, you deduct allowable expenses and deductions from your total rental income. However, not all expenses are allowable for income tax. Firstly, expenses must be solely for the property business to be allowable. This is known as the wholly and exclusively rule. Where this isn't the case, the expense isn't allowable. However, where you can show a separate amount or part of the expense is solely for the property business, that amount or part is allowable. You may have a property which you partly let and partly use yourself. Your expenses may cover both the rental and non-rental part of the property. In these cases, work out a reasonable part to use as an expense for the property business. For example, where you let a quarter of the property and use the rest for private purposes, you could claim a quarter or 25% of the expense. You cannot claim any expenses for the time you spend on your property business. But if you take on a paid employee to help run your property business, the costs of their employment are allowable as an expense when you work out your rental profits. Make sure you operate pay-as-you-earn correctly, even if they're a family member. HMRC has a wide range of pay-as-you-earn webinars if you want to find out more about this. If you're letting property at a reduced rate, your expenses may not be allowable. For example, if you let a property to a relative or friend below the market rate. This is because the expenses may not be solely for the purposes of your property business. However, HMRC will allow you to use expenses up to the amount of rent you receive, but not to create a loss for tax purposes. There are two types of expenses. They are known as revenue expenses and capital expenses, and it's important to decide which expenses you have as you treat them differently. Revenue expenses are your day-to-day running costs of the property business. For example, advertising, stationery, and insurance. Revenue expenses also include repairs. A repair is where you restore something to its original state without improving it. Some examples are repairing burst pipes, replacing broken windows or doors, and redecorating. Revenue expenses are allowable expenses. You can take these from your property income to work out your profit or loss. However, they must meet the wholly and exclusively rule. Capital expenses are the cost of things you use in the business over a longer time. For example, when you add something that wasn't there before, when you alter, improve, or upgrade something, or if you buy furnishings or equipment for a residential property. Capital expenses are not normally allowable expenses when working out your profit or loss. Keep permanent records of these costs though, as you may be able to claim them against capital gains tax when you sell or dispose of the property. So at this point now, I'm going to hand back over to Kathy, who's going to take us through the first polling question that we have for you today. So back to you, Kathy.
Thank you, Graham. Yes, this is the first polling question for today. And this is where you can take part in the webinar by selecting one of a choice of answers. No one else will see your individual reply, but we will all be able to see the overall result as a percentage of the total replies. And I'll show you this on the screen after the poll has closed. Your answers are useful feedback for us, so please get involved if you can. I'll just launch the first of the polling questions. And this question asks, which of the following is a revenue expense? And the options are an extension to a residential property, a double bed for a residential property, replacing a broken window in a residential property. I'll just give you a little time to take part if you want to take part in the poll. As I said, nobody sees your individual reply. We'll just see the result at the end. Right, thank you everyone who's taken part. We've had a very quick response and the voting seems to have levelled out now, so I shall just close the poll and share the result with you. There we are, there's the result. And most people have identified that the correct answer is C, replacing a broken window in a residential property. This is a repair and so allowable as an expense when working out your profit or loss. The other two are both capital expenses. So thanks everyone who took part. I'll just hide that and then we can move on. There are special tax allowances you may be able to claim for some capital expenses. They don't include the land or buildings. The two main allowances are capital allowances and the replacement of domestic items relief. We'll cover the replacement of domestic items relief later in the webinar. You may be able to claim capital allowances on the costs of some capital expenses. For example, a vehicle you use in the property rental business, equipment like tools and ladders used to maintain the property, and computers and other office equipment used for the rental business. You cannot claim capital allowances for furniture and items you supply for tenants to use in a residential letting. However, you may be able to claim these for items purchased for use in properties that qualify as furnished holiday lettings. Capital allowances allow you to deduct a percentage of the capital expense from your property income to work out your profit or loss. This may be what we call an annual investment allowance, sometimes known as an AIA, or a writing down allowance. If you're using cash basis, the rules for capital allowances are different. Except for buying a car, you can include the full amount of the capital allowance as an expense when you work out your profit or loss. This is instead of using an AIA or writing down allowance. Therefore, with cash basis, you only claim capital allowances when you buy a car for use in the business. We'll look more at motoring expenses later in the webinar. So let's look at an example of using capital allowances. You've purchased the following items solely for use in your residential property business: extension ladders, a computer, a combined printer and photocopier, a car. When using traditional accounting, you claim a capital allowance for the ladders, computer, printer copier, and the car. Remember, this is a percentage of the purchase cost for these items, which may be an AIA, that's annual investment allowance, or writing down allowance, though an AIA can't be used for the purchase of a car. If you're using cash basis, you should claim a capital allowance for the purchase of the car, and this must be a writing down allowance. However, the full cost of the ladders, computer, and printer copier can be claimed as an expense against your income. If you also purchased a double bed and some wardrobes for the properties, Whether you're using traditional accounting or cash basis, capital allowances are not available for these costs. However, capital allowances would be available for these items if the property they're purchased for qualifies as a furnished holiday letting. You can find an introduction to capital allowances in the Property Income Manual, PIM 3010 on gov.uk. As well as deciding if an expense is a revenue expense or capital expense, it's important to decide if an expense is a repair or an improvement. A repair is where you restore something to perform its original function properly. This may be by replacing parts of it. Repairs are a revenue expense, so you can include them as an expense when working out your profit or loss. Improvement costs are a capital expense. You cannot include them as an expense when working out your profit or loss. You may be able to claim capital allowances in some cases. If not, you may be able to use the cost of improvements when you work out any future capital gains tax, if they are still in place at the time. So here's an example. A landlord has an ordinary tap which is dripping. He replaces the tap which is dripping with a similar kind of tap. This is an allowable expense as a repair. If the landlord replaces the ordinary tap with one that has a pull-out spray head, then this is an improvement because the new tap can perform more functions than the old one. This is a capital expense and cannot be included as an expense when working out your profit or loss. So what happens if a repair does not have a like-for-like replacement? If you use new or improved materials, this is still a repair or maintenance where the function of the asset remains the same after the work. A good example is where you replace single glazing with double or triple glazing. Other examples of repairs that may be allowable expenditure include stone cleaning, painting and decorating, mending or replacing broken windows and doors, repointing, and replacing roof tiles, flashing, and guttering. When you buy a property that is derelict or run down, the costs of putting it right are likely to be a capital expense. For example, where the property isn't in a fit state for letting, or you pay a cut price for the property because of its condition. You cannot include these costs as an expense when working out your profit or loss. However, you may be able to use them when working out any future capital gains tax. And now we're going to have our second polling question for today. So I shall just launch that on screen for you now. And this one asks, which of these is not a repair? And the options are replacing damaged laminate worktops with marble worktops, painting the kitchen cupboard doors, replacing damaged vinyl flooring with new vinyl flooring. So we're asking which of these is not a repair. And while you're taking part, I've just a few reminders for you that if you do want to save the questions and answers that are appearing in the question box, and you're on a mobile device, you'll need to take screenshots as you go along, as you won't be able to save the question and answer log. Also, there are handouts available for you to download during the course of the webinar, but also that you will receive a follow-up email that does have a link to a recording of the webinar and useful links. Also, there are a lot of questions coming in, and colleagues will aim to answer as many questions as they can today, but they may not be able to reply to them all. So thank you everyone for taking part in the poll. Voting seems to have levelled out now, so I shall close the poll and share the result with you. And again, most people have identified the correct answer, which is A, replacing damaged laminate worktops with marble worktops. This is not a like-for-like replacement, it would be an improvement. So it would be classed as a capital expense and not a repair. Okay, I'll hide that poll and I'm going to hand you back over to Graham now.
Yeah, thanks very much, Kathy. So let's now move on to look at expenses you have before starting to let property. And expenses you have before you start letting your first property must meet all these conditions to be allowable when you do start letting. They must be solely for the property business. Again, this is the wholly and exclusively rule. They cannot be capital expenses. They must be within 7 years before the rental business starts, and they would be allowable if they were spent after the property business starts. Where the expenses meet all these conditions, treat them as if you incur them on the day the property business starts. After starting to let your first property, costs you have before letting a second property in the same property business are treated as normal expenses of the property business. We're now going to look at mortgage and finance costs. Finance costs include interest on mortgages and loans. This includes loans to buy furnishings. Other finance costs, such as fees and the related costs of getting or repaying a mortgage or loan, are also allowable costs. Only the interest part of a mortgage or loan repayment is allowable. Repayments of the amount borrowed are not allowable. These are known as capital repayments. Since April 2020, all allowable finance costs from residential property are used to work out a basic rate tax reduction to your overall tax bill. The basic rate is currently 20%. This means you cannot use any finance costs from a residential property as an expense when working out your profit or loss. It doesn't affect individuals who rent out a property that qualifies as a furnished holiday letting. It also doesn't affect commercial property lettings like offices or shops. For these, use your finance costs as an expense to work out your profit or loss. If you have a loan that's used for mixed property types, only the part of the loan for residential property is used to work out the basic rate tax reduction. For example, a loan used for a shop and the flat above it. In this case, work out a reasonable portion of the loan costs for each type of property. So I'm now going to give you a basic overview of how to work out the tax reduction if you're an individual with just one property business. And most landlords won't have to work out the tax reduction. The online self-assessment tax return will do this for you. I'll show you where to enter your figures on the tax return shortly. To work out the tax reduction, you need to consider 3 different amounts. The first amount is your total residential finance costs for 2022 to 2023. Add to this any unused finance costs you've brought forward from an earlier year. This is any amount that you couldn't use to work out the basic rate tax reduction in 2021 to 2022. And I'll tell you more about this shortly. The second amount is the profits of the property business in 2022 to 2023, less any losses from an earlier year. The final amount is your adjusted total income. Your adjusted total income is usually your total income for the year, less any losses and reliefs, less savings and dividends income, less your personal allowances. So you now have the 3 figures you need. Your total residential finance costs, your property business profits for the year, and your adjusted total income. The next step is to see which of these figures is the lower amount. If you have just one property business, the tax reduction is 20% of the lower amount. If your total residential finance costs are not the lower amount, you aren't using all your finance costs in the year. So you can carry forward the difference between the amount used to work out the basic rate tax reduction and your total residential finance costs. Then you use this in the following year when you work out your basic rate tax reduction. So as an example then, your total residential finance costs are £10,000. Your property business profit for the year is £6,500 and your adjusted net income is £32,750. So your property business profit is the lower amount and is used to work out your basic rate tax reduction. However, you have £3,500 residential finance costs which you've not been able to use, which you can carry forward to the following year. If you have more than one property business, you must work out the tax reduction separately for each of them. If this is the case and your adjusted total income is the lower amount, you may need to do a further calculation. This is because the basic rate tax reduction cannot create a refund of income tax. You can find out more about calculating the tax reduction in the Property Income Manual, PIM 2058. To finish off this part of the webinar, I'll now show you where your figures go on the online tax return. On the Expenses for Other Property Income page, only show allowable finance costs from properties that are not residential. Do not enter any residential finance costs. On the Profits and Losses for Other Property Income page, show your residential finance costs for the year here. When filling in your tax return, remember that the Help About link under each question gives guidance about what you need to enter. On the same page, show the amount of unused finance costs you have brought forward from an earlier year. The total of your residential finance costs, plus the amount you enter here, cannot be more than your profit for the year. You can carry forward any balance to the 2023 to 2024 tax year. When you view your calculation, you'll find the amounts used to calculate the basic rate tax reduction here. In this example, the total residential finance costs are £18,500. That's £16,000 from 2022 to 2023 and £2,500 brought forward from 2021 to 2022. £11,430 is used to work out the basic rate tax reduction. This is the maximum possible without creating an income tax refund. This means £7,070 can be carried forward to 2023 to 2024. So at this point now, I'm going to hand back over to Kathy to take us on to the next section. So back to you, Kathy.
Thank you, Graham. Let's move on to travel expenses you may have. You can claim the costs of journeys between different properties which are solely for the property business. If you run your property business from home, you can also claim the costs of travel from home to the let property and back. However, the journey must be solely for the property business. This could be by using your own vehicle or by public transport, for instance, by bus or train. You must make sure that you only claim travel expenses that meet the wholly and exclusively rule. If a trip is for a mixed purpose, none of the expenses allowable. This is because you cannot separate the business and private part of the journey. For example, if you travel to your rental property and decide to do some shopping on the way, none of the costs are allowable. If the only purpose of the trip is for the rental business, you will be able to claim the full expense. Here are some examples. Callum and Sue decide to visit their rental property on their way to relatives in the area. They cannot separate the business and private elements of the journey, so none of the travel costs are allowable. Mia is staying with relatives. She travels from her relatives to her rental property and back. The business journey is separately identifiable, so the costs are allowable as an expense. Individual landlords can use two different methods to work out their expenses when they use a car, van, or motorcycle for business journeys. They can choose to use the actual running costs and claim capital allowances for the purchase of the vehicle. Otherwise, they can use a fixed mileage rate. You must use the same method all the time you have that vehicle for your business. So if you used the actual costs for a vehicle last year, you cannot use the fixed mileage rate for the same vehicle this year. When you use the actual costs method, you need to keep records of all your running and maintenance costs. You also need to record your annual mileage and business mileage. Work out what percentage your business mileage is of your annual mileage. Use this percentage of your total motoring costs as your allowable expenses. You may also be able to claim a capital allowance for the purchase of the vehicle. The fixed mileage rates are the same as for other businesses. For cars and vans, that's 45 pence per mile for the first 10,000 miles and 25 pence per mile thereafter. For motorcycles, it's 24 pence per mile. These rates cover the whole cost of running and maintaining the vehicle. You cannot claim any other expenses or allowances for the vehicle. Whichever method you choose, always keep full records, including journey logs and mileage records. As we said earlier, there are special allowances for some capital expenses. The replacement of domestic items relief is for landlords of residential property. It allows them to deduct the actual cost of replacing furnishings from their property income to work out their profit or loss. It doesn't allow the cost of buying furnishings for the first time, only replacement costs. So what do we mean by domestic items? Well, they include movable furniture like beds and freestanding wardrobes, furnishings like curtains, linens and carpets, household appliances such as televisions, fridges and freezers, and kitchenware like crockery, cutlery and pans. Domestic items do not include items that are a fixed part of the property. For example, baths, sinks, boilers, or fitted kitchen units. These may be an allowable expense as a repair to the building, as long as there is no improvement. You cannot use the relief for furnished holiday lettings or commercial property lettings, for example, shops and offices. You can use it for unfurnished, part furnished, and fully furnished residential property. There must be an actual cost for buying a new replacement domestic item. The new item must be solely for use by the tenants, and the old item must no longer be available. If the new item is an improvement, you can only claim the cost of buying an item which is the same as the original. Let's look at an example. Ash has a partly furnished residential letting. A chair needs replacing, so he buys a new chair. He can use the whole cost of the new chair as it's a like-for-like replacement. If Ash replaces the chair with a sofa, he can only use the amount it would cost to replace it with a chair. The price difference between a chair and a sofa is an improvement. He cannot use the whole cost at this point. If he later replaces the sofa with another sofa, he can use the whole cost, as this is a like-for-like replacement. Where the replacement is a reasonable modern equivalent, this doesn't count as an improvement. The full cost of the replacement item is allowable. An example would be a replacement fridge with an improved energy efficiency rating compared to the old fridge. So the amount you can claim as relief is the allowable cost of the new replacement item. Where there's an improvement, then limit the relief to the cost of replacing the original item. Add on related costs for disposing of the old item or buying the replacement, and then take off any amounts you receive when you dispose of the old item. You can find out more on gov.uk. And now we're going to move on, and we're going to have our third and final polling question, which I'll just launch on screen for you. And this question asks, for a partly furnished residential letting, which one of the following can you claim using replacement of domestic items relief? And we have a replacement boiler, a replacement bed, a replacement bath, none of the above, or you don't know. And as I said originally, nobody sees your individual reply. We just see the total votes at the end. So I'll just give you a little time to do that. And while you're doing that, just to remind you that you will be receiving an email in the next few days that does have a link to a recording of the webinar, plus useful links. Also, if you're on a mobile device, you need to be taking screenshots, as you won't be able to save the question and answer log. Also, there are handouts available to download during the course of the webinar. But if you are unable to download the handouts, then again, the email that you'll receive in the next few days will have the links contained in the email. Also, it's a very busy webinar, so colleagues are aiming to answer as many of your questions as they can today, but may not be able to reply to them all. So thank you everybody for taking part. The voting seems to have levelled out now, so I shall close that and share the result. And the correct answer to this is B, a replacement bed. Domestic items don't include fixtures, and it doesn't matter that the letting is only partly furnished. So thanks everyone for taking part. I shall hide that now. We're nearly at the end of the webinar now, so here's a summary of what we've covered today. We've looked at expenses and deductions for residential property, including revenue and capital expenses, repairs and improvement costs, expenses before letting out a property, mortgage and finance costs, travel costs for business journeys, and the replacement of domestic items relief. If you do need more help, our full range of help and guidance can be viewed online from your mobile, tablet, or PC at any time. And links to further help and guidance are included in the handouts. And as I said earlier, just a reminder for saving the question and answer log if you're using a PC or laptop. Then select File and then Save Questions Log at the top of your control panel. You can also save the questions and answers log from a Mac on the GoToMeeting toolbar, select File and Save Questions. If using a mobile device or tablet, you need to take screenshots as you're not able to download the questions and answers log. The control panel will close at the end of the webinar. So if you want to download the handouts and the questions and answers log and haven't yet done so, we will give you time to download these at the end of the webinar. And I'll leave the webinar open for around 5 minutes to allow you to do this. Just to remind you, we will also send you an email that includes a link to a recording of the webinar and useful links within the next couple of days. When the webinar has closed, you will be directed to a short survey. Your feedback is very useful and helps us to keep developing our webinars. Please do not send in any more questions, as these will not be answered in the 5 minutes that the webinar will be left open. So thank you to everyone involved in today's webinar, and also thank you to all of you that have attended. It will now go quiet for 5 minutes to allow you to download the handouts and the question and answer log. So from Graham and myself and the team in the background, I'd just like to say goodbye.